Hey, it's Rav. Welcome to the Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. The challenge often is that we take our precious time, we go to work, we get paid in order to eat. But imagine a life where money could make you money so that you could work a little less, have more time for those things that matter most. Family, friends, engaging in some sort of purpose greater than yourself. That's what this show is all about, teaching you how to grow your money. Don't go anywhere. We'll be right back. Coming up, we're talking to Darren Mitchell, and he's teaching us how we can make money investing in the infinite banking concept.
Wealthy people invest in themselves. You are the golden goose. You are the golden goose laying a golden egg every single day. If you're making 100 grand, what investment can you make in yourself to make you a better employee or a better employer or better real estate investor?
Hey, it's Rav. A few years back, I learned about trading stock options by taking the Theta Trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I am not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Hi, it's Steve Aho at Canada's Mortgage Choice. As many of you have heard, there are banks and there are brokers. And it's interesting to know that some people still don't know the value that a broker can bring. One thing that's really important to know about brokers is that they have multiple products, as many as 60 to 70 lenders that are available that have at least 4 or 5 of their own products. How does this differ from a bank? Well, a bank has maybe 3 or 4 products that can help, but what happens is you get shoehorned into their products and you are not exposed to the many, many options that do exist that a broker can provide. If you need to know more about this or you're interested in knowing more, please contact Canada's Mortgage Choice. We're here to help.
Hey, it's Darren Mitchell. In this episode, I want to teach you how to be wealthy. In the last episode I was on, I talked about what was wrong with traditional financial planning, why that has failed the business owner, the real estate investor, and the person looking to invest for passive income. In this episode, I'm going to give you basically a master class on how to be wealthy. And if you want to be wealthy, remember, it is a skill. It is a skill that can be taught, and is it a skill that can be learned. Tony Robbins has a great quote, "Success leaves clues." If you want to know how to be wealthy, look at what the wealthy people are doing, right? So for me, the big turning point in my career and my financial life was 2008. I was salmon fishing in Alaska, having a great time with my buddy, trip of a lifetime, and then the market started crashing 1,000 points an hour. So that taught me that I was not in control of my money, and I certainly wasn't in control of my clients' money. So I spent the next 2 years touring North America, visiting with wealthy people, learning from coaches and mentors, and you'd be amazed at how much people will share if you just ask them. So what I've come up with is really 3 ways to become wealthy, or 3 things that the wealthy do that a lot of other people don't do. So if you want to be wealthy, this is what you need to do. Number 1, wealthy people invest in themselves. You are the golden goose. You are the golden goose laying a golden egg every single day. If you're making 100 grand, what investment can you make in yourself to make you a better employee or a better employer or better real estate investor, better at passive income? Investing in yourself, you bring that 100 to 150 or 200, you multiply it by the next 30 years, that's going to be your greatest rate of return. You want to be a real estate investor? Join a real estate investing group. This can be one for free, this can be one you pay for. Don't think of it as an expense, think of it as an investment in you. What about a coach? Do you have a coach? Why not go and get a coach? That investment in you to make you better is the greatest investment you're ever going to make. Warren Buffett was asked this year at the Berkshire Hathaway meeting, he said, someone asked him, Warren, where should I invest in during a recession? And Warren smiled and said, same place you should invest any other time. Invest in yourself is always the greatest investment. So wealthy people get that. We've got a 24-year-old client here in Ontario. At 24, he joined a real estate investing group. He hired a coach. His coach is here in Ontario. And he learned to invest in multifamily apartment buildings. He bought a 14-unit building with none of his own money. That investment in that skill that he learned is going to mean millions of dollars throughout his lifetime. And what do most people his age worry about? Whether their $5,000 RSP contribution did 6, 8, or 10%. Who cares about that? Make yourself better. Second thing wealthy people do, they invest in businesses. If you want to be wealthy, invest in a business. And the third thing wealthy people do, they invest in real estate. Now, when I say real estate, I want to include here hard assets. Hard assets could be private lending, land development, gold, silver, Bitcoin, but hard assets. That's what wealthy people do. Invest in yourself, invest in a business, invest in real estate. But investing in these three things is really step two. Step one is, where do you save your money on an ongoing basis? Where do you save it? Or where do you store the wealth you have now? So let's look at that. Okay, so we talked about step two being investing in yourself, business, and real estate. Step one is, where do I save my money on an ongoing basis? Or where do I store the wealth that I have accumulated? So this is the hierarchy of wealth. Okay, and I talk about a whole chapter about this in my book, Be the Bank, available on Amazon. The hierarchy of wealth, what I like to tell clients is, what's the most important part of your home? Well, the most important part of your home is the foundation. Unless you have a rock solid, bulletproof foundation, the whole house crumbles eventually. Same with an office tower, a condo building, or any office place at all. Without a strong foundation, eventually that's going to collapse. Well, your financial plan is the exact same. You need a strong foundation, and we use the hierarchy of wealth. Bottom of the pyramid is your foundation. And we believe that has to be a position of control, which can only be cash or cash value life insurance. Okay, and I'm going to show you today why cash value life insurance is a million times better, but we'll get to that. So that's your base. Now, once we establish that base, we don't just sit on it. We don't just say, hey, let's just keep our money there. What we can do then is we can act like a bank, and we can actually take that cash value and we can multiply those dollars, just like a bank, legally multiply those dollars, put it back into you, business, real estate. That's what the wealthy do. The idea that a financial advisor would say to a successful entrepreneur or real estate investor, you know, yeah, I know you're successful, you're buying properties, you're making money, you got a successful business, but nah. You know what you should do? You should give up control of all your money, put it in a nice balanced mutual fund at the bank in an RSP, wait another 30 or 40 years, cross your fingers, hope it works out. At 71, we'll turn that into a RIF, and if all goes well and taxes don't go up too much and the fees don't eat you alive, maybe you'll have enough to get by every month in retirement. That is just crazy for me, for a real estate investor or an entrepreneur. If you accept that this is where you're going to make your money, you've got to be in a position of control in order to take advantage of those opportunities, at least for a portion of your money. I hope that makes sense to you. Again, the key word here is control. You're not in control of your money if your money's in the stock market and the stock market drops 40%. You're not in control of your money if you're in real estate and that drops 30%. For a portion of your money, you need to be in control in a place that can't drop. So when do the sales happen in real estate and the stock market? They happen when things are going bad. Well, when things are going bad, your base of your financial plan can't be going bad. That has to be rock solid and going up. That's how you take advantage of opportunities. When everyone else is panicking, your base never changes, but just continues to grow, and then you multiply the money. Let's take a break. We'll be right back.
With the uncertainty we're currently experiencing in the investment landscape, It is an oasis in a desert to find a place where you can get not just one, but 7 different opinions in different investment streams, all for you to explore in just one day. Rav Toor, myself, and 5 of our friends are hosting the Everyday Investor Summit, where we're going to teach you multiple ways where you can safely and securely invest your money in the world of uncertainty that we're currently experiencing.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hi, it's Darren Mitchell. Welcome back to Everyday Investor. Now I want to talk about infinite banking, specifically the infinite banking concept. If you're here and you want to be up here wealthy, I'm going to show you how to get there faster with the infinite banking concept. So what is the infinite banking concept? Well, it's a strategy, not a product. Okay? It's a strategy that allows us to do a bunch of things. Right off the bat, it allows us to be in control of our money, allows us to multiply our money legally like a bank. Remember we talked about being like a bank? It allows us to compound, and we're going to talk a lot about compounding in this section. So control our money, multiply our money, compound our money, and act like a bank. So let's start with the compound curve right off the bat. So we all have one lifetime compound interest curve. We start here and it grows exponentially. This would be the exponential growth curve from high school we all remember. Now, there's 2 sides to this curve. There's side A and there's side B. What side do you think the wealthy hang out on? Well, the wealthy love to hang out on side B. They want these big gains, big, huge gains. And guess where the middle income earners or the lower income earners in Canada hang out? They hang out on side A with these little gains. Or even worse, most of the people in Canada hang out closer to the zero line where they really have nothing. And zero line, you can get there 2 ways. You can be a debtor or you can be a saver. So let's talk about the debtor. How does a debtor end up at 0? The debtor borrows money, pays it off. Borrows money, pays it off. Borrows money, pays it off. They end up at 0. But the saver, no. Mom and dad or grandma and grandpa, all these experts told me you should save your money and pay cash. Well, that's great. If you do that, you don't pay interest. But the second part of that equation is, what do you lose? Well, you lose all the growth on that money for the rest of your life. So you lose interest or lose growth. So a saver looks like this. Saves, pays cash, saves, pays cash, saves, pays cash, saves, pays cash. They still end up at 0. Now the wealthy, they don't believe in, they're not debtors, they're not savers, they're wealth creators, and we're going to talk about that. So when it comes to compound interest, we think of compound interest like a snowball, okay? So you're outside with the kids, you get a little snowball, you're rolling it, pretty soon you get the base of a snowman. And what do the kids do? The kids jump on it, play around, and then that snowball smashes down to 0. Well, that's exactly what a saver does. They save, and then when they pay cash, they smash that snowball and put it back to 0. Now I want you to picture, what if we could take that snowball and we could roll that snowball, keep rolling it for the next few years, next 10, 20, 30, 40, 50, 70 years or more. Think if you continually rolled a snowball for the next 50 to 70 years. That's what uninterrupted compound interest is. Not just compound, uninterrupted. Lots of people have compound interest, but then they interrupt the compounding. Wealthy people know there's 4 wealth destroyers that you need to avoid if you want to roll that snowball and have a massive snowball in 50, 60, 70 years. And those 4 wealth destroyers, number 1, this is probably not going to be a shock to most Canadians out there, that live in a heavily taxed home, that drive in a heavily taxed car with heavily taxed gas, with heavily taxed income tax, and then they invest their money and they're heavily taxed, or they put it in an RSP thinking they have a tax deduction, but really it's just a tax deferral and they pay a lot of tax when they get it out. Tax is your #1 wealth destroyer. If you don't get a handle on tax, it's going to be really hard to be wealthy. The second thing wealthy people really get a great handle on are fees. Fees can erode your wealth unbelievably over the long term. An extra 1% fee could mean an extra, or 15 to 19 years less income in retirement. So you've got to manage those fees. The next one is volatility. Think of the stock market, up and down, up and down, up and down. Well, wealthy people, they're going to manage that volatility for when opportunities come along. And then finally, spending. And that's kind of what we talked about. The debtor borrows, pays it off to zero. The saver saves and pays cash. So, how does this apply to an infinite banking policy? Well, picture your savings if we put them inside a cash value life insurance policy, and we allow that money to continue to grow completely tax-free for the rest of your life. Well, Darren, you're talking about cash, but life insurance doesn't have cash, it just has a death benefit. You're right, but the type of product we're talking here is not the type of life insurance you've heard of before. This is a specially designed, high cash value life insurance. It comes with two components. It comes with a cash component and a death benefit. For our purposes, we're going to focus on the cash value today. The death benefit's nice, but really, people typically start an infinite banking policy for the cash value. So we're going to put the cash value, put money in. The cash value is going to continue to grow literally for the next 50, 60, 70 years until the day you die. Great. So now we've got money growing in there. But what about these amazing opportunities when I want to invest in myself, in a business, in real estate? What about when an amazing opportunity comes along? How do I access my money? Do I just cancel my life insurance policy and go back to zero? No. Wealthy people don't interrupt the compound interest curve. When you have a cash value life insurance policy that's designed properly with an advisor that knows what they're doing, ideally an authorized, Nelson Nash authorized practitioner, then you can access up to 90% of the cash value, no questions asked. So in this scenario, you're saving inside your infinite banking policy, you're compounding. Then in 2024, 25, we have a massive correction in real estate, stock market, everything's on sale. Everyone else is panicking, everyone else can't access money, but you're a smart infinite banker and your money, not only did it not go down, it continues to go up because an infinite banking policy never goes down in value. I want to say that again. An infinite banking policy, the cash value never goes down in value. It's guaranteed to go up every year, and they have a 150-year track record of paying a dividend each and every year. So the money's compounding along, opportunity presents itself. You can get that neighbor's house for 30 or 40% off what it was just last year. What do? You call up the insurance company and say, hey, I'd like $100,000 or $50,000, anywhere up to 90% of your cash value. And I said no questions asked. They will ask you two questions. They'll say, Darren, do you want a check or do you want a deposit in your bank account? That's it. Now again, I caution you, this is not every life insurance policy. This is a specially designed high cash value life insurance policy. So we've been able to compound our money tax-free and take advantage of the opportunity. So we're saving for the long-term tax-free, but we're also able to use our money in the short term. Okay? So now we basically have introduced to you what we call the AND asset. Now I have AND here. I talked about control, multiply, and compound your money. When we talk about multiplying your money, we call it an AND asset. Every other asset you have is an OR asset. Do I invest in the stock market or in my business? Do I put money in my TFSA or do I hire a coach? When you have an infinite banking policy, you have an AND asset. Your money, number one, is inside this policy compounding tax-free for the rest of your life. and you've been able to access up to 90% of that money to go take advantage of this opportunity, land development, real estate, private lending, whatever that opportunity is. And your money's also providing a death benefit. Just like a bank, we're multiplying money so it's in more than one place at the same time. Okay? So we've multiplied money. Are we in control of our money? Well, I talked about control. If everything crashes, guess what happens to the cash value life insurance? It doesn't crash, it goes up. We saw that in 2008. We saw it again in 2022. Everything else went down. Cash value life insurance, they increased the dividend in 2022. Continues to go up each and every year. Okay, so we've got taxes. What about fees? The fee on this, the investment management fee, is about 90% less than a mutual fund. That's right, 90% less. So again, there's a small fee, small investment management fee if it's set up properly, but there is a fee that's very, very small compared to anything else. What about volatility? There's no volatility whatsoever. What about spending? Well, again, we don't need to go into debt or we don't need to smash that savings. We can grow our money completely tax-free. So if you think of this, is this a good place to save a portion of your money? You put money in, it compounds tax-free for the rest of your life. And you get to multiply that money use it for opportunities. And you get to have a death benefit that if something happens. There's all kinds of other benefits we'll get into subsequent shows, but that's the highlight. Now let's give some real world examples of how would I use this. So I like to do private lending, right? I did some private lending a few times now, and if you had asked me 15 years ago, oh yeah, Darren, you're loaning money out at 15%, you know, what's that all about? Well, I would assume I had to break someone's legs or something to collect 15%. But what did I do? I invested in myself, I joined a real estate investing group, and I found out private lending happens every single day. So when I had an opportunity to loan $100,000 out at 15%, I said, that sounds great. I had great collateral for the loan. The developer I knew personally had a great track record. But I didn't use my money. I'm trying to do exactly what the wealthy do. I left my money in the policy to compound for the rest of my life completely tax-free. I called up the insurance company and I said, hey, can I have 100 grand of your money? They said, sure. They didn't ask me what I was using it for. They didn't ask me when I was paying it back. They didn't ask for payment terms. They just said yes, and the money showed up in my account. I gave that money to the developer. Year later, he cuts me a check for $115,000. I took that money. I paid off the $100,000 loan with the insurance company, plus about $5,000 in interest. They charged me interest on that loan. And now I pocketed the $10,000. That is an and opportunity. That loan did not affect my growth of my cash value whatsoever. When I say that again, whether you have a loan or whether you don't have a loan, your cash value grows completely the same every single time. All right, Darren, so you do this and you take advantage of all these opportunities in the next 10, 20, 30 years. Not only do you take advantage of opportunities, but you can take advantage of opportunities when no one else can access money. They're not changing their line of credit. They're not changing the terms. Contractually, 90%, no questions asked. But Darren, then I'm gonna get to my 60s or 70s if you're an entrepreneur who never really retires and you're like, what do I do with this cash value or this death benefit, all this life insurance stuff now? I don't want to take advantage of any more deals. I've already multiplied my money. I have a bunch of and assets. I'm wealthy, I'm doing great. I was able to take advantage of those opportunities. What do I do with this now? Well, now we're going to spend that money completely tax-free in retirement. If it's set up properly with the right type of loan, we can start taking tax-free loans each and every year in retirement, and these tax-free loans, we never pay back. Now, when I say never pay back, we never pay back till death. And at that point, we have a massive cash value, and the death benefit's always larger than the cash value, so we have a massive death benefit. The tax-free death benefit comes, pays off the outstanding loan, and the balance goes completely tax-free to your family. Now, I want you to picture this in retirement. Whatever retirement you figure you're going to have, what if you had an extra $80,000, $100,000, $200,000 a year of tax-free money to top up your retirement lifestyle? Well, that's what an infinite banking policy can do in retirement, because we're not just compounding for a few years. we're going to compound literally till the day you die. You could retire at 60 and say, great, I'm going to retire here, start borrowing against your cash value, and your cash value will continue to compound the next 20, 30, 40 years. Most people, when they retire, if they have $1 million, the next year they have 950, 900, 800, they start spending it down. But infinite banking policy never stops compounding until the day you die. That's why these loans that you can take in retirement tend to be much higher than a traditional investment, because we're never stopping the snowball. Okay, so let's review. We're in control, we multiply our money, we compound our money. We avoid the wealth destroyers, taxes, fees, volatility, and spending. We take the money and we put it where the wealthy wants. We want to invest in ourselves, business, and real estate, but we don't use our money. We literally multiply money using the insurance company's money, so our money's in more than one place at the same time. Then we get a huge tax-free death benefit to pay off that outstanding loan in retirement. Tax-free growth, tax-free loans, tax-free retirement. That was a quick overview of infinite banking policy. In the next episode I'm on, we're going to break it down how real estate investors can use infinite banking to multiply their returns. Don't miss it.
And now it's time for our investing tip of the week.
Hi there, it's Rachel Oliver from Clover Properties. This week's teaching is focused on something that stumps a lot of investors who are just starting out with their real estate investing journey. They ask, well, what is the difference between owning a rental property and owning a rent-to-own property? So let me break it down. There's actually three key There are three key differences, and I'll cover those today. The first one starts with the fact that a renter gives you first and last month's rent. In a rent-to-own, there is no first and last month's rent. The renter, or we call them the tenant buyer, has the intent to purchase the property. So they're actually giving you a down payment. And that down payment can be $20,000, $30,000, $40,000, $50,000, $60,000, depending on how much they've saved up and depending on what kind of a property they can afford. So the best part is that down payment helps the tenant buyer become mortgage ready through the rent-to-own process. But what it does for the investor side is it offsets some risk. And the best part is if that tenant doesn't keep up with their monthly payments, the investor who owns that rent-to-own property gets to keep that initial down payment that they received from the tenant buyer. A whole heck of a lot better than just keeping their last month's rent. The other point that is a differentiator between a rental property and a rent-to-own property is the fact that most rental properties, whether they come tenanted or whether you vacate the tenants, there's a little bit of work that needs to be done to that property. Some renovations need to be put into the property, and that takes time and that takes money. And in my view, that delays my ability to make money. In a rent-to-own, you cash flow from day one. The day that you get the keys, the day that that tenant buyer moves in, you have a cash flow check, and that can be anywhere from $700, $800, $900 a month after all of your expenses. And the third differentiator is that maintenance and repairs in a rental property falls on the landlord. In a rent-to-own, the tenant buyer that is renting to own is signing a contract agreeing that they will handle all maintenance and repairs for the full term of the rent-to-own. That could be 2 years, 3 years, 4 years, depending on the circumstances, but they are contractually obligated to look after maintenance and repairs, and if they don't, they're in breach of the contract and lose the exclusive right to purchase that property under the rent-to-own conditions. So those are the top three differentiators between a rental property and a rent-to-own property. See you next time.
And thank you guys for watching. Without you, we would not have a show. If you want to see this show again or you want to see any of our other shows, make sure you go to everydayinvestor.com. You can watch them there. Click on episodes. It's like watching on demand. Make sure you also sign up to receive the episodes right into your inbox. Look forward to seeing you next week. Same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.